Are Bitcoin treasury companies a systemic risk to the price of Bitcoin? This is a question I've been asked a lot recently. And it's kind of funny because, as we all know, Bitcoin has been the best performing asset of the last 16 years. Nothing has really come close. And yet, it's still considered a highly contrarian trade to simply own Bitcoin, let alone allocate a significant portion of your portfolio to it. Despite its historical outperformance, Bitcoin remains highly misunderstood. And then on top of that, you have Bitcoin treasury companies. To me, this seems like the contrarian trade within the contrarian trade. You have traditional financial professionals who do not own any Bitcoin at all, and they absolutely lose their minds over Bitcoin treasury companies. Specifically, they are outraged by leveraged Bitcoin equities, companies that borrow money and use the proceeds to buy Bitcoin. But it is not just the TradFi world. Even many hardcore Bitcoiners do not like the idea of Bitcoin treasury companies either. To them, pairing leverage and counterparty risk with Bitcoin violates the point of Bitcoin, holding a bearer asset with no counterparty risk. And to make matters even more polarizing, you have Saylor and Strategy, who continue to push forward new forms of fixed income securities, primarily through preferred equity structures. While Saylor does a great job explaining what these instruments are and how they function, to the outside world, it can look like complex financial engineering. And historically, whenever there is complex financial engineering that people don't fully understand, it creates concern that there may be hidden risk. When that concern grows, people start asking whether there is a large systemic risk building up, not just to the companies themselves, but to the broader Bitcoin market. I think it is entirely rational to be skeptical. Healthy skepticism is a good thing. But if you take the time to actually look into how Bitcoin treasury companies operate and examine how their capital structures are built, I do not see any meaningful systemic risk at this time. And the reason why is simple. The leverage is minimal. If you compare the Bitcoin treasury company industry to something like the real estate market, the difference is night and day. In real estate, it's completely normal to put 10 or 20% down and borrow 80 or 90% of the value of the home. That is effectively 5 to 10x leverage on US real estate. Bitcoin treasury companies are doing the opposite. They put 80 to 90% down in equity and only borrow the remaining 10 to 20%. That is incredibly conservative. In fact, if you look at the most levered Bitcoin treasury companies in the world, they are sitting at 10 to 20% debt to Bitcoin net asset value ratios. And those are the extreme cases. Many of the smaller companies are even lower. Not only is the leverage modest, but the structure of the debt is also favorable. Most of the financing has long or infinite duration. Whether it's convertible debt with 5-year terms or perpetual preferred equity with no maturity date, most companies are not using short-term debt that needs to be rolled over or refinanced. The money is not due anytime soon, which removes much of the liquidity risk and the refinancing pressure that causes blowups in traditional financial crises. So while it is important to question where the risk may be building, the current fear and uncertainty around Bitcoin treasury companies triggering a future Bitcoin crash is likely overblown. Now, this doesn't mean that Bitcoin can't fall in the short term. Bitcoin is a volatile asset. It moves in cycles. But it does mean that we are not currently dealing with a highly leveraged industry that is vulnerable to systemic collapse from a cascade of margin calls or defaults. That risk is simply not present in the current structure of Bitcoin treasury companies as they exist today. In fact, I am incredibly optimistic about the long-term future of Bitcoin and Bitcoin treasury companies. Saylor has done an excellent job showing the world why these new financial instruments, these Bitcoin-backed securities, serve a real need. They allow traditional pools of capital to gain exposure to Bitcoin in ways they understand, and they offer investors the choice to access Bitcoin with or without leverage through either equity or fixed income. And if the trend continues, it is possible that things could start to accelerate from here. Thanks for watching, everyone, and see you next time.